Problem 17. In this problem, you're calculating the predetermined overhead rate. Page 56, Chapter 2 of your textbook has the formula for predetermined overhead rate. The formula is estimated overhead cost divided by estimated activity base. In this problem, they mention for you to calculate the manufacturing overhead rate based on direct labor hours. So since we're looking at estimates, we would look at the budget amount, not the actual amount. So our manufacturing overhead is $750,000, and we would divide that by direct labor hours of 60,000, which would give us a direct or predetermined overhead rate of $12.50. Question number 20. In this question, you're being asked to calculate the cost per equivalent unit for conversion costs. So you have to first determine your number of units in order to then calculate your conversion costs. This is asking you to use the FIFO method. Make sure you understand how to calculate your units based on the FIFO method or the weighted average from Chapter 3. The first part of the calculation they're doing is to actually calculate the units. So 100% minus 40%. We're taking that minus 40% in your problem. It states beginning work in progress or beginning work in process was 40% conversion cost. So we have to take the amount subtracted from 100%. So we actually would have 60%. So our beginning work in progress units, 12,000. We multiply that by 60%. And then we're going to calculate our ending. We have units transferred in minus ending work in process, which would be 4,000. And then for this next figure here, we're taking what it states in the problem, ending work in progress was 25% for conversion costs. When we're doing the last part of this equation, we do not subtract this 25% from 100. That's only at the beginning when you're looking at the beginning units that you do that on the FIFO method. On the FIFO method and on the weighted average method, at the end, when we're looking at the ending work in progress units, we take whatever it says the percentages. So 25% times our ending work in process units is 4,000. That's where this 7,200 comes from. That's the 60% times this 12,000. The 4,000 here is the 8,000 units transferred in, subtracted off ending work in process units. And then the 1,000 is 4,000 times 25% based on our ending work in process units at 4,000 and our conversion cost percentage is 25%. When you add these numbers together, you get 12,200 units. So now that you know your units, you can then calculate your cost per equivalent unit. So we're taking our 80,000 under the conversion costs. Says costs added during the period are 80,000. So 80,000 divided by our units gives us approximately $6.76 for conversion costs per unit. Make sure you understand the difference in what they're asking. You may get a question on the exam that asks you just to calculate the number of units using the FIFO method. If so, then this is all you would calculate, and once you've calculated that, you would be done. If it asks you to calculate your cost per equivalent unit using the FIFO method, you have to make sure you first do your units, and then after you calculate your units, then you need to go in and calculate what your cost per equivalent unit is. Problem number 31. In this problem, you're asked to calculate your contribution margin. Your contribution margin formula is sales minus variable costs. So this one's kind of straightforward. It lists some information up here for you. One of the things that it lists is what your sales are. And then in this information, it also tells you what your variable costs are. You have 220,000 variable costs from the cost of goods, and then operating expense has 70,000 variable costs. So we're going to take our sales, 500,000, minus our 220,000 variable costs, and also minus the 70,000 variable costs from the operating expense. It gives us a contribution margin of 210,000. Problem number 33. This problem almost piggybacks along with the previous problem. You want to make sure you know what your break-even calculation is. In Chapter 5, page 177, the break-even points in units, the formula is fixed costs divided by contribution margin per unit. Remember in the previous problem, in order to get the contribution margin, we had to take our sales minus our variable costs. So in this sense, we have sales would be $15 because it says a product sold for $15 minus our variable costs of $9. That's going to give us a contribution margin of $6. So now we take our, as the break-even point in units formula states, you take your fixed costs divided by your contribution margin. We calculated our contribution margin to be $6, so we take 60,000 because that's fixed costs, and we divide that by 6, and we get 10,000 units. Problem number 34. Once again, this is kind of building from the previous problems. One thing to keep in mind when you have these exercises, everything's not going to be just one formula that you have to look at. You may have to calculate certain things in order to use your formula first. So for instance, in this one, we're calculating our break-even in sales. Our formula for break-even in sales would be fixed costs divided by our contribution margin ratio. So we don't know what our ratio is. In order to calculate our ratio, the contribution margin ratio is contribution margin per unit divided by sales per unit. So we must first calculate our contribution margin ratio. So when we look at our contribution margin per unit from the previous, remember that is your sales minus your variable costs. So we have $400,000 in sales, and our variable costs are $280,000. That gives us $120,000 for our contribution margin. Now we need to actually calculate what our contribution margin ratio is. So we'll take that contribution margin and divide it by the sales price. And our sales price in this one is $400,000. So this is the first part of what they're doing in order to calculate the contribution margin, taking our sales minus our variable costs. We get that figure, and then we want to take that figure and divide it by what our actual sales were. So 400,000 minus 280,000 gives us 120,000. Now we divide that by 400,000, and that's going to give us a 3% contribution margin ratio. Now we can go in and plug this in to, or 30%, I'm sorry, contribution margin ratio. So now we can go in and plug in our formula for break-even points in dollars, fixed costs, $400,000 divided by our contribution margin, or our fixed costs, I'm sorry, of $84,000 divided by our contribution margin ratio, that 30% we calculated. So $84,000, and then divide that by 30%, and that gives us $280,000 as our break-even point in dollars. These formulas are on page 176 and 177 in chapter 5. Make sure you understand those formulas, and keep in mind sometimes you have to calculate something else first in order to use your formula. In this case, we had to calculate the contribution margin ratio first before we could actually use the formula for break-even points in dollars. Problem number 35. In problem number 35, it's asking you to calculate the company's income next year if it implemented the plan. The plan is to reduce variable costs by $2 per unit. So before we can even get to the point of using our net income formula, which net income is sales minus fixed costs minus variable costs, we need to find out how much our variable costs will be when we reduce it by $2. Okay, if you notice, nowhere in here does it actually state what the variable costs are now per unit. So in order for us to do that, we have to first know what our variable costs currently are per unit. That's this first part of the calculation, variable cost per unit. We're taking our $360,000. It says variable costs were $360,000, and we're dividing it by the number of units sold, $20,000. That gives us $18 per unit. That's our old variable costs. So now we want to look at what the company wants to do now. They want to reduce their variable costs by $2 per unit. So we take our $18 per unit, subtract $2 per unit, and we now have $16 per unit. So now we need to calculate what will be our new figures. What will be our new net income? So we need to know what our sales are. It tells us we have, in here it doesn't state exactly the figure of your sales. You have to calculate it. 20,000 units sold at $30 per unit. That's this 20,000 times 30. Gives you 60,000 units. That's our sales. Now we have to determine our fixed costs. It tells us in the problem we have fixed costs of $200,000, and we also have, and they're going to increase their fixed costs by $25,000. So we have our old $200,000 fixed costs plus an added $25,000 fixed costs. That's now $225,000 fixed costs. So we've calculated our sales at $60,000. We've calculated our new fixed costs at $225,000. Now we just have to calculate our variable costs. Our new cost per unit is going to be $16 per unit. So we multiply this by our number of units, 20,000. That gives us $320,000. Now we can calculate our new net income from our formula. $600,000 sales minus our fixed cost of $225,000 minus our variable cost of $320,000 gives us a net income of $55,000. Problem number 36. Once again, this one kind of piggybacks with that previous one. In this one, the company is letting you know how many units they've sold, what they sold it at, what their variable costs, fixed costs are, and they want to know how much would the company's profit increase next year if they sell 30,000 units versus 25,000 units. So we first have to look at what is their net income currently. So this is where this old net income is. Our sales, 25,000 units times $20 per unit minus our fixed costs minus our variable costs gives us a $50,000 net income currently. Now if they were to increase their units of production, before we can even begin to calculate the increase, we need to know what is our variable cost per unit, like we did in the previous. So our currently we have $300,000 in variable costs. Divide that by the number of units that were currently being sold. Gives us a net variable cost per unit of $12. Now we can go in and calculate what our new net income would be. We're now going to be doing 30,000 units, still at $20 per unit, minus our fixed costs of $150,000 as stated, minus our new variable cost, which is 30,000 units times our $12 per unit, gives us the calculation below, and we get a new income of $90,000. Now they didn't ask what will be the new income, they asked how much would the company's profit increase. So if we have a new income of $90,000 or new net income of $90,000 and our old one was $50,000, our new net income increases by $40,000 if they do 30,000 units. Once again, this problem is going exactly like the previous problem, problem 38. In this problem, they're once again wanting to know how will total profit change if the volume is increased to 11,000 units per month. So once again, we're calculating what our old net income would be, sales minus costs. Remember, these costs are fixed costs and variable costs. So our sales, we currently sell 10,000 units according to the problem at $12 per unit, and then our costs, our fixed cost, or if we do our fixed or variable, it doesn't matter which way you put them in, they are still got to be calculated. In this case, they put variable first. So our variable costs are, it says $5 per unit. So we take our 10,000 units times $5, and then our fixed costs are 30,000. So we have sales of 120,000 minus variable costs of 50,000 minus fixed costs of 30,000 gives us a net income of 40,000. This is our old net income. Now we calculate our new net income. They are wanting to increase to 11,000 units. So 11,000 units times what we sell them for at $12 per unit gives us 132,000 as our sales, and then our variable cost will be $5 per unit times our 11,000 units gives us $55,000 variable cost, and we still have fixed costs of 30,000. That would give us a new net income of $47,000. So the difference between the old net income of 40,000 and the new net income of $47,000 means our profit will increase $7,000. Problem number 39. The formula for this one is in Chapter 5, page 186, Degree of Operating Leverage. The actual formula states contribution margin divided by pre-tax income, which is the same as net income. Remember previously in a couple of problems we had to calculate our contribution margin. We calculated that by taking our sales minus our variable costs. And in here it's $800,000 minus variable costs of $410,000. And then we divide that by our pre-tax income, which is also called net income. Net income from our previous problems, as you recall, is sales minus variable costs minus fixed costs. So we would be taking our net income. So the good thing about this problem, they've already given you the figures. You didn't have to go calculate contribution margin, but it's important that you know what this degree of operating leverage calculation is. In this case, they already gave us our contribution margin, $390,000, net income, $210,000. $390,000 divided by $210,000 give us the operating degree of operating leverage at 1.86. Problem number 49. In this problem, they're asking you to calculate what the variable overhead efficiency variance is. That formula is actual labor hours minus standard labor hours times our standard variable overhead rate. Okay, so we have to decide what information do we have. Actual labor hours. The problem states actual labor hours are 4,100 hours. So we have that figure. The standard labor hours, when we look at that, it's the standard labor hours set is per unit, and it says 2 hours per unit. So we have to take our 2 times our 2,000 units in order to know what our standard labor hours are, because it doesn't actually give us the formula, the actual number. We have to calculate it. So 2 hours per unit, 2,000 units gives us $4,000 times our standard variable overhead rate. And in this case, it states it for us. Standard variable overhead rate is $10. So when you take 4,100 minus your 4,000 times 10 gives you 1,000. Problem number 54. In this problem, you're asked, by what amount would the income of the company change if the decision is made to outsource the production? So we have to look at our current and then how much it would change to really be able to see the difference of the two. So current, we take the costs that are considered relevant or avoidable costs. Those would be your direct materials, direct labor, and variable overhead. Fixed overhead will not be counted in this. Fixed overhead is considered an unavoidable expense. The reason being is it's fixed. It doesn't matter whether you produce units or not, you're still going to incur that fee. or that amount. So we do not add that in. We only want to look at what would be considered our avoidable expenses: direct materials, direct labor, variable overhead. We add 88,000 plus 46,000 plus the 4,000, and that'll give us 380,000 as our total cost currently. Now we need to know what are our costs of these units. So the problem states 10,000 units times $14 per unit is the cost. So that's $140,000. So $140,000 is our what would be our cost to produce these 10,000 units. So 138,000 was our first total cost. Subtract out our new total cost of 140,000, and we actually are losing we're actually losing $2,000. Problem number 55. This problem actually doesn't require you to do any true calculations or anything. It's really asking you to look at the numbers and see whether they should accept this order. The company, keep in mind also, on these problems you may have a problem that has a lot more information than what you need. So you have to look and really see, what do you need to do? What is it that you're looking for? And in this problem, it states that if the company decides to do this special order, it would be 5,000 units at $8 per unit, which would be $40,000 that they would have to do. But it also states in this problem, after you read through everything else, that there was an analysis of costs using activity-based costing that suggests incremental costs associated with the special order would only be $34,000. So, should this be something they do? Yes, the incremental revenue, the $40,000, 5,000 units times the $8 per unit, is going to exceed the actual incremental costs. Their real costs will probably be $34,000. So this works in their favor. Problem number 61. This is one where you want to make sure you understand and you've looked at the formula for the initial rate of return and whether something should be accepted or rejected. The initial rate of return, you will take that and minus the hurdle rate. If the figure you get is greater than 0, then it should be accepted. If it's less than 0, it should be rejected. Well, when we take our internal rate of return and then we subtract out our hurdle rate, we actually get something less than 0. This one mentions 4% as our initial rate of return, and then our hurdle rate in the problem states 8%. So 4 minus 8 makes a negative. Therefore, we're less than 0. We want to reject this. So no, we don't want to accept this. Problem number 68. These problems come from your chapter 13. You want to make sure you looked at chapter 13. There's a page in chapter 13 that actually lists all of the financial analysis formulas. You want to become familiar with that. You may have a problem that you will have a problem, at least one, that asks you to calculate one of those types of financial analysis. Which one, we do not know, so you want to make sure you're familiar with them all. In problem number 68, you're asked to calculate what is the earnings per share. This problem asks you for your earnings per share. The earnings per share formula is net income minus preferred dividends divided by average common shares. In this problem, it states for you average common shares of 2,000, net income is 10,000. It does not state what the preferred dividend is. It shows you a dividend per share, but because it does not actually tell you how many shares are actually sold, you can't calculate a preferred dividend. Usually it will state what the preferred dividend is. So in our formula, net income minus preferred dividends, so our net income is $10,000 minus preferred dividends, which is 0. divided by our common shares. Average number of common shares is 2,000. So $10,000 divided by 2,000 gives us $5 as our earnings per share. Problem number 69. In this problem, they're asking you to calculate the acid test ratio. Once again, those formulas that you want to make sure you understand are in Chapter 13, page 505. The acid test ratio formula states cash plus short-term investments plus accounts receivable divided by current liabilities. So in this problem, you may have problems where they give you the actual numbers already. But for this one, we actually have to determine our top part of our formula. So we look at our cash. We have cash of $10,000. Short-term investments, that will be our marketable securities of $30,000, and accounts receivable of $25,000. So we must add those together. That's the first part of what you're seeing. In this formula, they actually did kind of like worked it in backwards. They took total assets and subtracted out the property and plant, as well as subtracted out the prepaid expenses and inventories, since those are not counted as cash or short-term investment or accounts receivable. So whichever way makes you comfortable, either to take the total assets and subtract out what isn't considered short-term, or just take your cash, short-term investments, in this case is marketable securities, and your accounts receivable. Add those numbers together. And then you want to divide by your current liabilities. Your current liabilities are going to be your accounts payable and accrued payables. Okay, so when you get those numbers, we have $65,000 as our top number divided by $50,000 gives us 1.3 for our acid test ratio. Problem number 70. In this problem, they're asking you to calculate the debt to equity ratio. Make sure you've checked out page 505 in chapter 13 for all of these formulas. For the debt to equity ratio, it's total liabilities divided by total equity. Our total liabilities are accounts payable, accrued payables, and long-term payables. And then we're going to divide that by our equity. Stockholders' equity of $70,000 gives us 1.86.